Well, with Republicans now in control of the House, they are expected to fight against President Obama's efforts to only extend tax cuts for those households making less than $250,000 a year. So what will happen, and how will a new Congress affect business? Let's ask Moody's Analytics chief economist Mark Zandi. He joins us live from Westchester, Pennsylvania this morning. Good morning to you, Mark. You know, there are people who say gridlock's good. There are people who say gridlock is dangerous. I mean, do you think that as a result of yesterday's election that businesses have any more reason to go out and spend some of the cash they've been sitting on?
Well, I think there are pluses and minuses to gridlock. One of the pluses is that I don't think there will be any major economic policy decisions, save for what we're going to do about the tax code in the next couple of years. And that'll give business people a chance to digest all the epic policy changes that have already occurred, regulatory reform and healthcare reform. I think they need some clarity with regard to those big changes before they go out and hire and invest. So I think a policy timeout, so to speak, would be a plus from this gridlock.
So if it's a policy timeout, puts the onus on the Fed. To talk to me about QE2, I mean, is that truly a substitute for fiscal policy?
Well, I think it would be prudent to have a bit more fiscal stimulus to complement the QE2. I do think the recovery is very fragile and it could use some additional help from fiscal policymakers. But the odds of that are now much lower, and so it does put the onus on the Federal Reserve. And so the Federal Reserve is going to have to be more aggressive, and at the end of the day, the QE that they actually do will be greater than it would have otherwise have been.
So, I mean, short of rolling out another stimulus plan, let's talk about some of the actions that might be stimulative. The corporations like Cisco's chief John Chambers out there saying, you know, let me repatriate some of the cash that I keep abroad. Do you think that we will see any real move on corporate tax rates in this new administration? Can you broaden the base and lower the tax rate?
Yeah, I think that's an area where there might be some compromise, but at this point I'd put the odds of any major corporate tax changes at well below even. The one idea that Mr. Chambers has of perhaps providing a bit of a tax holiday to get some of those earnings overseas back here in the United States, that has, I think, some momentum. But again, I think the odds are less than even. I think if we're going to do something like that, it probably has to be in the context of broader tax reform, and even in a broader context in trying to address our long-term fiscal problems.
Well, let's talk about the near-term push on tax rates. We've got this December 31st date hanging over our heads. Yeah. Will Congress have any resolution before that, or do we see a de facto decision because Congress can't come to a resolution?
I'm hopeful. I think they will compromise. My sense is that the compromise will be that no one's tax rates rise in 2011. The recovery, I think, is too fragile, and it would be a risk that to take raising taxes on even upper-income households. But I do think by 2012-13, the economy will be in a good enough place that those tax rates can go back to where they were for those upper-income households. And I think that'll be the compromise. By 2012-13, we'll see the phasing in of those tax increases for upper-income households.
So you do see an extension there. Do you see a redefinition of what it means to be middle income versus high net worth?
Possibly. I mean, one other potential compromise is to allow the tax rates on people, let's say, that make over $1 million a year. Right. I think, that has some momentum. More likely, though, my guess is, and it's hard to handicap this, obviously, I don't think anyone's tax rates rise in 2011. 2012, the tax rates for upper-income households making over $250K, they will revert back to where they were in the 1990s. That'd be my guess at this point.
Mark Zandi of Moody's Analytics is with us. Mark, are you expecting quantitative easing, and what do you expect it to look like?
Yes. The financial markets fully anticipate $500 billion in Treasury security purchases over the next 6 months, and I think the Fed is going to deliver on that. The financial markets have driven up stock prices. Interest rates are lower. The dollar is down. If the Fed doesn't deliver, then all of that comes unwound. So I think there's a lot of incentive for the Fed to give the markets exactly what they anticipate.
But explain, because there are plenty of skeptics out there, explain to me how this further easing of monetary policy will be stimulative. How does that get corporations to spend their cash? How does it get them to create jobs? All the things that are sort of constipating progress.
Right. Well, I think there's a number of key links. One key link is getting fixed mortgage rates down. They're now near record lows because of the anticipation of QE. That's helping mortgage refinancing, and it helps support housing demand as well as it's being supported. It's brought the stock market back up. Stock prices are back close to where they were prior to when the European debt crisis hit us in the spring. And higher stock prices, I think, are very important for the economy, particularly business people. It's a signal for them to go out and invest and hire and help support confidence. So I think the higher stock prices are also supportive. And then, of course, then the lower dollar helps with respect to trade. So those are the key linkages between quantitative easing and economic growth.
Yeah, the liquidity is being created here, but it's not staying within these borders. Others could say, I mean, you get China moving and India moving and Australia moving to try to cool off the money flows, because that's where the money is chasing down those opportunities overseas. So why do you expect that to fuel equities or to fuel more entities here at home?
Well, you're right. Some of that liquidity is finding its way overseas into emerging economies and driving up stock prices and other asset values there. But it's also driving up asset prices here. The stock market is much improved over the last couple of months since financial markets began to anticipate quantitative easing. So I think QE has had a major impact on stock prices here. And that's very, very important. The economy is very sensitive to any movements in the equity market. And I think that will be a big plus. There are negatives. This is one of those things that isn't a slam dunk positive, but on net, it is a plus.
When you and I spoke last back in August, you said there was about a 1 in 3 chance of recession again. What do you see now?
Yeah, Margaret, I'm surprised you remember that. You're right. 1 in 3, and that is still my handicapping of double dip odds. The economy is growing about 2%. That's real GDP, the value of all the things that we produce. That's below what we need to maintain even a stable rate of unemployment. So unemployment at 9.6 will continue to rise. And when you're growing at that pace and unemployment so high, you're vulnerable to anything that can go wrong. And it's not hard to construct scenarios. So given that, I think the odds of a double dip are still uncomfortably high at 1 in 3.
Quickly, because we got to leave it here, tell me what you're expecting out of the jobs figure. And then also, you were saying that you don't expect any increase in taxes until about 2012. Do you expect President Obama to be looking at a much healthier economy as he faces re-election in that year?
Well, to the first question, I think we'll get 90K on payroll jobs. Excuse me, that's 90K on private sector payroll jobs. The top line will be 70K because we'll lose some government jobs, so 70,000 top line growth in payrolls. I'm of the view that if the economy makes it through the next 6-9 months without backtracking to recession, and odds are that we won't, that by this time next year and certainly by 2012, we'll be in a much better place, and the economy will be at the back of incumbents in the next election.
Well, we will see, Mark. It's always great having you on the show. Thanks for making the time today.
Thank you.